The housing market is at an all-time high. The S&P 500 is at an all-time high. SPACs are giving untested tech companies crazy valuations that they don't deserve, and IPOs like Coinbase, Roblox, and soon enough Robinhood are being hyped up like the dot-com bubble never ended. There are so many people out there right now who believe that we are in a bubble, myself included. But what's really interesting is hearing what some of the best investors in the world have to say about our markets. Michael Burry, Warren Buffett, and Ray Dalio are some of the best investors to ever live, and all of them seem to want to make their thoughts known. Today, I'm going to show you what Ray Dalio has to say, the man who founded and ran the biggest hedge fund in the world, Bridgewater Associates. But really quickly, if you're new here, subscribe to the channel. We're putting out loads of videos just like this constantly that you don't want to miss out on.
A bunch of years ago, I started to think about, well, what is a bubble? What do I mean when I have a bubble? Because I watched a lot of bubbles over my something like 50 years of investing. I basically thought there were 6 things that made a bubble in my mind, and I'm going to rattle them off, then I'll apply them so that you know what I think. First, how high are prices relative to the traditional measures of prices is a consideration. For example, are PEs high or yields low and that kind of thing. That's a consideration, but it's not what I mean by a bubble. Let's say, for example, you can have prices high, which means returns low, and you can have that go on for a very long time. That doesn't mean a bubble pops. So I'm really looking at whether you get a pop, but still it's an ingredient. So that's one of the considerations, but it's not all. The second is prices are discounting unsustainable conditions. So unsustainable starts to be part of this picture of a bubble. Unsustainable means that by the nature of the buying, whoever is doing the buying and however that supply demand, that means that won't be sustained, and that produces a correction or prices going down. And then there's this speculative element, number 3. So one of those measures of the speculative elements is new buyers in the market. They're attracted in the market. It's the sort of thing where, you go to a cocktail party and people who are never involved in the thing are investing in it. And that could be tech stocks and it could be real estate and whatever, but, they're drawn in, and that there's big bullish sentiment. So everybody wants, not having these things makes you feel dumb, that kind of thing. And then also, number 5 on my list is big purchases, forward purchases. Like if somebody's buying apartments that they don't own because they think that the apartments are going to go up. Or back in the days where I traded a lot of commodities, I would watch that those who used commodities would, rather than buy from hand to mouth, they would get a lot of forward coverage. In other words, buy inventory to protect themselves against the prices going up. And so when they go from, as we have recently seen in commodities, when they go from not having forward coverage because prices went down and they kept falling and they say, I don't want to own it, to and then it going up and they say, I want to be protected against it going up, that movement causes a lot of buying and so on. So that's buyers that have extended those forward purchases are an indicator that I use.
So that's how Ray Dalio and Bridgewater Associates, the largest hedge fund in the world, are looking at our markets and trying to gauge whether or not we are in a stock market bubble. But these principles can apply to other markets outside of stocks as well. We can use them to look at the housing market or the crypto market or even the bond market, and then look at our economy as a whole and try to come to a consensus surrounding not only the stock market, but each and every other asset market out there. So if we look back to the first consideration, are prices high relative to traditional measures? You might think that only applies to stocks in terms of price to earnings ratios or dividend yields, but we can apply this principle to the housing market and even the crypto market. With housing, it's quite simple. What is the average yield on a rental property? Is it higher or lower than the historical average? And the answer to that question can help guide us as to whether or not there is a housing market bubble. But it's also possible to look at the crypto markets and consider what the average returns are for staking certain coins like Ether and Cardano and comparing them to historical averages as well. Now, the main problem with this is that there aren't really any historical averages because these coins are just so new. But in 10, 15 or 20 years, it's very, very likely that people will be looking at staking yields as an indication of crypto bubbles. Next, we have whether or not prices are discounting unsustainable conditions, which is extremely relevant in 2021 as our governments are printing money and throwing it at their citizens in order to continue stimulating spending. Well, the simple truth is that this is not sustainable. We can't keep printing money forever. So any company which has built its brand around selling to overeager customers who are spending their stimulus checks will find that their business model is unsustainable in the long run and their high valuation might have been a result of a bubble. Next, we have whether or not new buyers have entered the market, which is perfectly personified by the old saying that if your shoeshine boy starts giving you stock tips, it's time to get out of the market. But once again, this can actually be applied to first-time home buyers or first-time crypto investors as well. If millions of people are rushing to enter the market, more so than normal, then prices are going to be forced up and this could be the start of a bubble. With crypto, this is seen every time Bitcoin hits an all-time high. The news stations start reporting it and people who have never even heard of Bitcoin or Ethereum a week ago are suddenly diving headfirst into Coinbase. The fourth point is whether or not there is broad bullish sentiment, and it usually goes hand in hand with the third point. A great example of this is Tesla over the last year or so. Some people saw Tesla as an immensely valuable company with huge potential and bought the stock for a fraction of what it's worth now. The fear of missing out then caught millions of people, leading to an EV stock boom where companies with no products and no real future, Nikola being the most obvious, find themselves valued at billions of dollars. The fifth consideration is the amount of leverage that investments are being made with, which obviously includes margin debt on stocks, but also applies to the housing market very nicely. A very simple question to ask is, how much of a down payment do you need to buy a house these days? And the answer can be as low as 3.5%, which is just ridiculous. Pretty much our entire housing market is propped up by excessive amounts of mortgage debt, which is a very potent bubble indicator and was the cause of the last great financial crisis. And finally, we have whether or not businesses or people are extending their forward purchases. Now, what this means is that usually a business like a brewery, for example, will buy a certain amount of barley 1 year in advance to make sure it has enough barley to brew its beer and make its money. But if the brewery is unsure of what the future holds, they might buy 2 years of barley in advance just to be safe. Excessive amounts of forward purchasing by companies or people can be a sign of a bubble. So that table right there shows us pretty clearly what Ray Dalio thinks about the stock market right now, and it's pretty hard to disagree with him at all. By all measures, we are at the start of a bubble or already halfway through it, but Ray Dalio doesn't think it's done growing, and he doesn't think it's about to pop either. Now, it is infamously hard to try and predict when a bubble will pop, and it's above all of our pay grades, but that doesn't mean it isn't worth paying attention to these measures and keeping an eye on the markets. Just because I won't be taking all of my money out of the markets and shorting the S&P 500 doesn't mean I won't be allocating some of my portfolio to inflation hedges or crypto investments. Not everything has to be a full measure. We can make efforts to reduce the effect of a bubble popping on us without missing out on the huge potential gains that are right within sight. If you're new to the channel and you enjoyed the video, then subscribe and hit that notification bell to make sure you don't miss any videos. If you want to help spread the word, then like the video, leave a comment, share it, and YouTube will do its part by pushing this video out to more people just like you and me. There's far more content just like this coming out soon. Thanks for watching. Until next time.